Welcome back to another podcast. Thanks for watching. This topic is going to be very interesting. It's a breaking news. We can share some important updates around the housing market. My name is Seewing and my co-host is Julie. Thank you for being my co-host. You've
Thank
been
you.
an amazing co-host. Without further ado, let me share my screen and let me go through the very important topics around the housing market just from a high level. And as of today's date, which is the 2nd of May, I'm covering a lot of important news, breaking news, what have you. So today, this article is from Mortgage News Daily and they provide very real-time updated mortgage rates update for everyone. And today's mortgage rate is 30-year fixed rate mortgage is 7.41%. Now this 7.41% is geared toward owner occupied by not investors. Investor loan rate a little bit higher. We'll discuss that later on during this presentation. Now, bear in mind, this ideal mortgage rate, 30-year fixed rate, 7.41%, is mostly for people who have 25% down payment to buy an owner occupied property. And they usually have a FICO score of at least 750 or higher. So this rate alone is geared for the highest credit rating following the highest level financial profile. Now, for example, if you are a owner occupied buyer which want to buy a primary home, and if your credit is lower than 700 FICO score, credit score, and you have less than 25% down payment, you are not likely to get this 7.41%. You'll most likely get a little bit higher, 7.7% or even 8%. Now, yeah. So let's go over an investor, which we work, this is what we do, you and I do my investment network. So as an investor that's trying to buy a rental property, investment loan mortgage rate is usually higher because you are non-occupied buyers as opposed to primary buyer owner occupiers. If this prime rate is 7.41%, then the investment loan rate, if you do not buy down the rates or you finance at typically 20 to 25% down payment normally. So your mortgage rate is probably 7.7, 7.8%, even 8%.
Okay.
Right? So investors, mom and pop investors, especially when you try to finance a rental property at the various markets, cash flow could be very challenging for you because you're paying a lot higher rate. So does that mean that you should not buy investment property? No. But that if you find the right market, the right team, the right network, such as us, putting cash flow, right? You can achieve positive cash flow as an investor getting it. We'll cover that momentarily, but any thoughts on that before, Julie, for you, before we...
I think when you just said something earlier, I think the encouraging thing is it's not all gloom and doom, even though the rates are slightly higher than they've been over the last several months. And if you get in the right market in the right area, you can find some cash flowing properties. So as we have.
Yeah, again, I don't want to spend too much time on this module. Let me share. This is a very popular Case-Shiller index. The headline is home prices soar even higher in February. So let's do a quick deep dive on this article. Came out 2 days ago. Home prices soar even higher in February 2024, despite higher mortgage rates, says S&P Case-Shiller. So I'm not going to go over the entire article, but I can say that the key points as mentioned right here is that home prices in February 2024 jumped 6.4% year over year, okay, according to Case-Shiller index. So let's see what else that I could pick on, what paragraph, before we go on to another topic on this video. Then is the home prices in February. Okay, it was the fastest rate of price growth since November of 2022. And then it further go to say that U.S. home prices is at or near all-time high. We keep hearing for the past few years, all-time high, record-breaking, skyrocketing, all these buzzwords, good or bad, these words will pop up on a daily basis throughout the social media. So you take it with a grain of salt. Some, buzzwords, headlines, positive or negative. You have to do a deep dive to get the real data and trends. Just don't go by the doom and gloom negative headline. So that reminding me, what are your thoughts on what I just said?
Yeah, I agree with you 100%. They're saying near all-time highs. That can indicate, okay, if it's at a high, then it's going to decrease and it's going to go down to a low. And I think it causes a lot of fear in people. But I
Yeah,
think the main thing is you have to look beyond the headline, like Donald Trump, the fake news, because you don't really know what the situation is until you really explore the market and the territory and get the right mortgage lender, the right team ahead of you to really help you achieve your goals. So I would say, don't worry about the headline.
exactly.
Bottom line.
Yeah, agreed wholeheartedly with you, 100%. Let me quote just one more short paragraph before we go to another article. Among the top 20 housing markets, prices in San Diego saw the biggest gain among the 20 cities on this core logic index, if you will. And the San Diego housing market gained 11.4% year over year from February 2023. And various markets throughout the country has also have increased in housing value year over year. So with that in mind, let's go over the next article, which is the Redfin article, which I follow quite a bit on a weekly basis. And the headline for today, published May the 2nd, as of the date of today's recording, this is fresh news.
Real
Breaking.
time.
Yeah, the headline is Housing Market Update. For the first time in nearly 2 years, there's no major American metro where home prices are falling.
Okay.
So that is good news, isn't it?
Oh, it is for us.
Yeah, Julie, the sky is not falling. It's all
Exactly.
doom and gloom.
Right.
The first paragraph, inventory is below April levels on typical April. Whenever there's a spring, each spring starting March, April, right? Spring housing buying season or a lot of activities. Current spring 2024 is not a typical spring.
Right.
Higher elevated mortgage rates. However, because of inventory is very low inventory, is driving home prices
Higher price.
up.
Mhm.
Continually rising mortgage rates are further eroding affordability. And that means affordability, that means more and more prospective home buyers, owner occupied home buyers in the country, past few years, they cannot afford, no longer afford to buy the typical median price of a home because of the skyrocketing home prices increases and elevated mortgage rates. So therefore, you and I have been discussing, Julie, that many people will be renting. There will be more renters moving forward ever before in the past American housing history, for that matter. Don't you agree?
Oh, absolutely. Absolutely. Which it's a benefit for those of us that do own property already because
Yeah,
they
yeah,
have to live
yeah.
somewhere.
Not
Right.
not only that, Julie. Yeah, our investors that purchase cash flow properties in our markets that we represent, they are getting very good cash flow at 25%
Absolutely.
down payment, and rent is expect to go up because, like we said, there are lack of homes to buy, there are lack of homes to rent,
Right.
and there are so many renters. They are fighting against each other to try to rent a place, so that will cause the rental yield to go up. For good news for real estate investors, mom and pop investors like you and I, and a number of our network investors. Make
Correct.
sense? Agree?
Absolutely.
Yeah.
Absolutely. 100%.
Yeah. Furthermore, based on this highlight on this article, high prices and rates drove the median monthly housing payment to a record $2,890, which is up a whopping 15% year over year.
Wow.
You, you look at 3 years ago during the pandemic, with the historical low mortgage rates. Uh, uh, During that time, the typical average monthly mortgage is around $1,500. Today, with higher prices, housing prices, and higher mortgage rate, today you have to pay $2,890 medium mortgage. So essentially, don't quote me exactly, but the difference of 2.5 years ago versus now, you require almost 100% to more in monthly mortgage in order to qualify to buy at today's uh, economic environment. Isn't that mind-boggling?
That's unbelievable. Yeah.
Yeah,
Hmm.
yeah. The people that, for whatever reason, that sat on the sidelines 2.5 years ago during the pandemic, when the rates were amazing, low,
Right.
and they, by waiting
Right.
2.5 years later, today, yeah,
Big difference.
it's a big difference. And so therefore, it's just so sad. All right,
It
now let's
is.
go on. Low inventory is driving up prices. Wow, that's not rocket science. It's low,
Exactly.
okay,
Basic
economics.
economics. Yes.
Yeah. By the way, I wonder at what grade that have we were taught about economics. Economics 101,
Go maybe.
high school, yes. Economics 101. What does that mean in terms of real estate, Julie?
Yeah, it is supply and demand. The lower the supply, the higher the demand, and the higher the demand, prices go up.
Exactly. That's right. That's right. And right now we have a historical low supply of inventory nationwide. And even though the mortgage rate is elevated, there are still pent up demand. Go figure.
Exactly.
So with that said, home buying demand is softening as rates rise. Yes, we agree with that.
Mm.
But even though the mortgage rates have risen to a very high level, still there are enough demand out there. Is that because here are the sentence. Still, there are still enough buyers out there to keep prices propped up. Yeah, still the demand is still greater than supply. So let's look at the Federal Reserve and Jerome Powell, the chairman of the Federal Reserve. They just had a meeting, I believe, yesterday or 2 days ago, and the Fed meeting is unlikely to push mortgage rates down.
Mm.
But the good news is that it won't push them up either. So
Right.
the way I look at this sentence is that whether you're a primary home buyer or whether you are Julie, whether you're a primary home buyer or whether you're an investor, I'm thinking you and I talk about it so often, right?
Right.
In the past few years.
Hmm.
Why the mortgage rate 7.5% or over 7%
Right.
for the remaining of this year, 2024? That sentence implied that with this kind of high rate, 7% or higher rate, that with us for the near term. And who anybody out there, especially primary home buyers, thinking, "Oh, I'm going to
Right.
sit in the sidelines. I'm going to wait until the mortgage rate comes down to 6% or 5.5% before I will jump into the market."
Mhm.
We could be waiting for a long time.
Yeah, and I think that speaks to the point where you just have to, once you make that decision, you just have to do it.
Mhm.
Because you can see you show the statistic over the last couple of years, mortgages have gone up, the average interest rates have gone up, everything has gone up. And those people that were waiting or hoping it was going to go back down to 4%, you just missed an opportunity to get into the market and experience the increased property values, the increased rents, all that. But you're just missing it by not making a move.
Yeah, absolutely. I told exactly. Here's one more thing here. One more highlight before we go to another article. Serious house centers, primary home buyers mainly, primary home owner occupied buyers who can afford today's mortgage rates and find a home they love, jumping on it now is not a bad idea, given the fact that inventory is low and the cost of mortgage rates are not dropping anytime soon.
Take the
Yeah.
decision and take the leap.
And the bottom line is, as we go over these two articles by Mortgage News Daily and CoreLogic and Redfin. My takeaway from these three articles is such that clearly the home prices is continue to go up at least 3 to 5% into the foreseeable future due to low supply and high demand, and due to the lock-in effect, right? The lock-in effect is going to be much longer than usual. So, in fact, let me give you the data. I don't have the exact data with me, but do you know 40% of all the homeowners in the country, they have no mortgages, free and clear, no mortgages. So they're sitting on massive amount of equity and wealth.
Yes.
They're not moving.
Right.
And furthermore, 90% of mortgage homeowners, they have mortgage rate of less than 6%. And around 60% of our homeowners have mortgage rate of less than 5%. And finally, 25% of the homeowners have mortgage rate of less than 3%.
Wow. They're not going anywhere.
They're not. Why would they go anywhere?
Exactly.
When they have when homeowner have a massive amount of equity, 3% or even 2.5% mortgage. I have several of my mortgages are 2.75%.
Nice.
You know, this lowering mortgages to you and I call it is a asset.
Oh, absolutely.
The historical mortgage, they're really locked in at 30 or 40. So mortgage is an asset. We're not going to get rid of that because that is our wealth. Why would somebody who have a 3% mortgage sell their house who's not under stress to make up to buy a new house with a 7.5% mortgage?
That doesn't make sense. No.
They have that pay the mortgage payment 2 times higher.
Yeah.
To try to qualify for a home, they'll probably not
be smaller than probably what they're selling.
So, with that in mind, Julie, that lock-in effect, if you will, will be prolonged. I believe this lock-in effect is going to occur for the rest of this decade. That is my belief.
Absolutely, I agree with you.
Right now, even though inventory has gone up, or the last few months of the 2024, around 15%, if you will, but we are still 40% less housing inventory for single family home than compared to the pre-pandemic. Still, it takes a lot. It takes a lot for supply of inventory to be released. As long as the mortgage rate stay at 7% or higher. Okay, so my takeaway on the article, once again, is that because of low supply and still pent-up demand, there's still a lot of qualified buyers out there, and 25% of the buyers out there, they're paying all cash.
Right.
25%. So there are people still flowing money into real estate, believe it or not. And these all cash buyers, they don't care about the mortgage rates.
Exactly.
And then the remaining buyers out there, they are putting 30% down payment, 40% down payment. They have a high income. They can afford the mortgage payment even at the elevated rate, knowing that in the next few years, maybe, we don't know, the future, the mortgage rate is bound to come down to from 7.5% right now, could be maybe 6%. And then people can refinance their loan down the road.
There you go. Absolutely.
You date the rate, but you marry the house.
That's it. So stop waiting. Just get in.
Yeah. As a matter of fact, so I'm gonna go over one more thing, which I'm gonna prove our point once again, which is right here. Now let's switch over to our investor, right? So again, I know fear is the biggest detriment to wealth building, especially for mom and pop real estate investors out there that are trying to buy rental properties. So the two main things, I don't know why they're waiting. They'll stay on the sideline. They stay on the sidelines. You and I clearly agree that because they're waiting for better opportunity in the future. They are trying to time the market. Okay. So never time the market. You need the time in the market So what I'm trying to say is, if you're waiting for the mortgage rate to come down to 4 or 3%, like we did in the historical low interest rate environment 2.5 years ago during the pandemic, guess what?
Right.
That ain't gonna happen anytime soon, unless there's another pandemic, unless there's some extreme world
God
economic
forbid.
crisis, right?
God forbid. But yeah, you're right.
That's not gonna happen. And also, if you wait for the housing prices to come down, that ain't happening either, because as we discussed, there's no stress in the market. Well,
Mhm.
people are sitting so comfortable within their massive equity they built up and locked in
Exactly.
36 rate. That mortgage rate was always 2.5%.
Mhm.
They're not going to sell. So there's no supply coming from the resale market. And the new builders, they're not building new homes fast enough to offset the lack of supply. I believe for the rest of this decade and even slightly beyond into the next decade, we will continue to have low supply inventory and still a pent-up demand. Economic one-on-one will apply
Yes.
for a number of years to come. And then there are some organizations that say we are still short. We are still short around anywhere from 3 to 8 million homes in the market,
Wow.
which is mind-boggling. So this shortage of homes persists for a while longer, a number of years longer.
So what it sounds like you're saying is for a homeowner or an investor, the longer you wait, the harder it's going to be for them to get into the market. Because if there's a shortage, prices are going to continue to go up. The interest rates may level off, they may stay the same, but the price of the house, what you can buy, your affordability, it will get streamlined because the prices of the houses keep going up. So it's better to get in sooner than later.
Julie, to your point, the cost of waiting is devastating, especially for investors, because you're losing the 4 pillars of wealth building when you buy a rental property, something you and I discuss quite often. You're
Right.
losing the opportunity to own the asset. And of course, you're losing appreciation potential by not owning a rental property. You're losing increasing cash flow, rents.
Right.
You're losing the loan amortization aspect. You're losing the renter paying down your mortgage for you. You're losing on the leverage portion. You're losing on the tax benefits. Multiple layers of wealth building children losing by not in them, by staying on the sideline. So
Right.
let me share my final scheme. I know I
Mhm.
don't want to make this any longer than it is, but let's go over some of the pro forma, right? On by buying again, let's do a little quick. Okay, I know you bought several properties from in this market in the Midwest and Buffalo and Idaho Falls,
Mhm.
even with a 7% rate, 7.3% rate at 25% down payment, you can still cash flow. Cash flow.
That's right.
Okay.
That's right.
Couple $100, just the first year cash flow. Okay. And then same thing. When you buy in the Midwest in a good market, such as the market presenting these duplex at 117, 25% down payment, your cash flow is $736, even with a mortgage rate of 7.3%.
Right.
You can't use the excuse of the high mortgage rate to prevent you from buying a rental property, because Julie, you know where.
Exactly. And I think the thing that your clients should know when you showed the first property at 67,000 and the fourplex at 173, those are not typos. Those are real prices. And I can attest to that because that is in line with the properties that my husband and I have purchased up in that same area in June. Yeah.
Yeah, let me give you another example. This new construction, I agree with you. Okay, you come from the horse's mouth, your mouth. Okay, you are experiencing amazing cash flow and even appreciation in the six
Right.
property that you purchased in Buffalo and Idaho Falls. So thank you.
Right.
Now, at the other market that we presented, new construction, single family home, choose in Florida and in Texas. And we have a buy. This is such an amazing buyer's incentive. Sellers, if the builders is incentivizing, they are buying down the rates for you, anywhere from
That's really amazing.
4.7% to 5.5%, 30-year fixed rate mortgage. So with a lower mortgage
Yeah.
payment, paying and getting this fast growing market in Florida and Texas, and even cash flow $300, right?
Right. That's really
We're
awesome.
first year cash flow. Okay, the same thing on this fourplex in South Texas, right? Even without any buyers, rate sellers, rate buy down, even with no buy down, even a 7.3% 30-year fixed rate mortgage for investors, you can buy this fourplex brand new in one of the fastest growing market in Texas, 545K, and the 4 doors rent at 5,400. And all that, you still have a monthly net cash flow of around $773, and you're getting a rental value ratio of 1%.
Right.
Where can you find a 1% rent to value ratio anywhere in the country, let alone in Texas, on this very fast
Exactly.
market in South Texas, new construction fourplex? This is amazing.
That's a great looking property.
So the excuse that people have about, and I digress, that's all I need to show. The two main excuses people have that are sitting on the sidelines, especially newbie investors, even
Right.
some experienced investors that or you and I have dealing with in the past few years. There's no reason to stay in the sidelines. If we could afford, if you have the 20 to 25% down payment as an investor, as a turnkey mom and pop investor, the two main things that people are waiting, I don't know why, is that they want to wait until the mortgage rate come down. They went over that. They went into that house. They're waiting for the housing crash. We don't have a crystal ball, but I don't. That's that. There's two scenarios not happening.
Yeah.
So for those fear-based mom and pop turnkey investors, especially in high-cost areas in California, you want to buy into a cash flow market. Excuse of waiting for the mortgage rate to come down, and excuse of waiting for the housing crash to occur, giving clear-cut data that you and I have been presenting is not happening.
It's not going to happen. It's not going to happen.
All right. Any other
Make a
final
decision right away.
Yeah. Any other recap you have?
No, I just think don't listen so much to the gloom and doom of the headlines. Be mindful of what's happening. But then really, when you're ready to get serious, get a mentor, get some help, get a realtor, get whatever, so that you can just go ahead and take advantage of where the market is right now. Because again, it's a long-term strategy. Even as a homeowner, you're going to buy it and sell it 2 years later. You know, you're buying it for a home for your family. So, and particularly for investors, understanding it's a long term. Over the long term, you will do very well. Statistics have shown property has always gone up, always gone up.
Yeah, I agree. Thank you for the recap. I have nothing more to add. But for those of people out there, if you see any kind of value whatsoever in watching this video, please like and subscribe to my YouTube channel. And better yet, in addition to that, I put your email at the bottom of the description, so you could put your email into our website newsletters, and you can become a free member of our real estate investment club, so you can learn more about real estate investing, or all free education for you, and coming to your email inbox on a weekly basis. Thank you for watching, everyone. This is Seewing, and our guest, Jimmy. Thank you.